Did you know that in last 20 years, Toronto home prices have skyrocketed by 350%? It is one of the best appreciating assets you can own. Yet today, nearly 50% of Torontonians rent their houses. So in today's video, let's discuss in 2025, are you better off renting or finally take that plunge into homeownership? And the answer is not what you might expect. Whether you are considering buying your first condo or townhouse or renewing your lease, this video will break down all the numbers, all the pros and cons, and will break down what makes most financial sense in 2025 for you. So, the very first one is the renting. It's a very simple calculation. In rent, you pay rent, your insurance, and utilities. It's flexible, upfront costs are lower, and you are not tied up to the market fluctuation in most cases. You are also not responsible for the maintenance of the house, and you have freedom to move easily. But is it always a cheaper option in a longer run? Now, in buying, it's a little bit more complex than renting in terms of the cost involved. In buying, you have two costs. The very first one is the upfront cost, and the second one is the ongoing cost. In the upfront cost, you have your down payment and the closing cost. In the ongoing cost, you have your mortgage, your maintenance, your property tax, and insurance. Now, let's take an actual number and see what makes sense for you. Now, most of the online videos of buy versus rent have a minimum down payment of 20%, but the place where I live and GTA coming up with 20% down payment on $800,000 house, it's not achievable by many first time home buyers. So, for the purpose of this video, we will be considering minimum down payment, and that is what most of the people are looking in today's market. So in this video, let's assume you are renting out a townhouse based in Kitchener. A typical townhouse over here costs roughly about $2,700 in rent plus utilities. And when we take buying into consideration, this kind of similar townhouse you can get in roughly about $700,000, and that is what we are considering for this video. So for a $700,000 townhouse, a minimum down payment that will come at $45,000, and the closing cost will be roughly about $15,000. So our upfront cost is $60,000. And the mortgage I've considered 4.5% with 25-year amortization. Usually, if you see a 20 or 30-year period of a mortgage, it comes at 4%. But in this one, I've considered a little bit higher because we all have seen what happens when the mortgage goes high. And that's what happened in past couple of years. So considering 4.5%, our mortgage comes at $3,770. The property tax would be $300 and maintenance is $292. Now, how I calculate maintenance, it's roughly about 0.5% of your purchase price per year that goes towards the maintenance. Now, this could be higher or lower, but the price that I have considered for the townhouse, you can get a pretty decent townhouse, not that old. Few updates would be included in that. So our total cost for buying comes at $4,362 plus utilities and insurance. Now over here we have a direct comparison of rent versus buy. So in renting we are paying $2,700 versus in buying we are paying $4,362. So that is $1,662 every month higher when you are going or opting for buying. Now let's see a detailed calculation in the Excel sheet of buying versus renting. Three bed, two bath, the purchase price would be $700,000. Now, if you want to rent this townhouse, the yearly rent would be roughly about $2,700, and that annually comes down to $32,400. And same goes for the purpose of this. I have considered 2.5% increase in yearly rent because that's standard in Ontario as of right now. So year one would be $2,700, year two would be 2,768, year three will be 2,837, and goes on. In the 25th year, your rent would be 4,884. Now, it's highly likely that you will stay at the same place, and there are also chances that the owner of the house could sell the house to someone else. Then you might have to move to somewhere else, and the rent could be really higher. But we are not considering that for as of right now. Now, let's take out the example of buying for the same house. The purchase price, as we discussed, would be $700,000. Down payment would be $45,000. So initial cash will require roughly about $60,000, including the closing cost of $15,000. The interest rate is 4.5%. So your mortgage on the very first year would be 3,770. Now, in Canada, we have 5-year term or 3-year term or a 2-year term, and it will fluctuate. But this is something we will be considering an average of the same mortgage for a period of 25 years. Now, when you pay a mortgage, there are two components of it, and that is something we will discuss in the later part of this video. One goes towards principal, and the second goes towards the interest. So when you pay $33,770, out of that, 1,265 goes towards the principal and $2,500 goes towards the interest. And then you also have property tax and maintenance on top of that. That comes at roughly about $4,362 every month. Now, as you live in that house for a long period of time, your principal portion go increases and your interest portion goes down. And again, this is something I will explain you in later part of this video why I highlighted year 6. So you can see over here our monthly cost is $4,457 and unrecoverable cost. So let's discuss what is unrecoverable cost. Now, unrecoverable cost, this is something I saw a YouTube video where accountant explained how this is a better way to calculate rent versus buy. Unrecoverable is something like you will not able to recover it. So in rent, when you are paying $2,700, you are not getting anything in there. Of course, you are getting a house, and same thing we will discuss in the mortgage as well. So mortgage, as I discussed, there are two components of it, the principal and interest. So out of the mortgage that we are paying $3,700, 1,265 goes towards the principal and 2,500 goes towards the interest. So $2,500 would be our unrecoverable cost. And when you buy a house, you have more unrecoverable cost, that is property tax and maintenance. So over here in our first year, we have $2,700 when we rent. That is like we are not getting it back. And when you are buying a house, you have $3,097 because our interest portion, that is $2,500, which we are not getting back, that goes towards the bank, not building equity on it. The other thing is the property tax, that is $300. The other one is the maintenance, that is $292. So total comes to $3,097 of unrecoverable cost. Now let's take another look over here in the Excel. In the year 6, what will happen? Yeah, our rent increases to $3,055 every month, and year 6, our mortgage still remains the same in that $1,580 goes towards our principal and interest reduces from $2,500 to $2,190 in the year 6. And again, I have considered property tax and maintenance increase in that as well based on the city average. Now, if you see a monthly cost of this, owning a house, that will be $4,457 compared to $3,055 for renting. But when we put a principal, because we are building equity on it, when we deduct principal, our unrecoverable cost comes at $2,877. That is lower than the rent that we are paying. Rent goes to $3,055 from $2,700 in year 6, considering 2.5% increase. And our mortgage goes down. What I mean by that is, like, if we consider year 1, our interest is $2,500 and the property tax is $300, maintenance is $292. So that is our unrecoverable cost of $3,097. That is higher than $2,700. But when you come into year 6, our interest portion lowers down, and that's how amortization works. So interest goes down to 2190. Of course, our property tax and maintenance both increases, but interest goes down, and that comes down to 2877. That's a total unrecoverable cost when you buy a house versus 3055 of renting when you keep on renting. Now, majority of the people would consider when they are renting versus buying is that whatever the difference they are saving in renting, they will invest that in some sort of asset or some sort of a fund where they can get some sort of a return. So that is something what we have considered over here. If we are renting the very first year, we have $2,700 in rent, and where we buy, we have $4,362. So that's the difference of $1,662. That is what we have seen initially. Now, when we invest this on a regular basis, and for the purpose of this video, I have considered S&P 500, and if you see S&P 500, they are giving roughly about 10% return consistently for past 25 30 years. So the very first one, if we consider that extra rent of extra amount of $1,662, if you're considering, if you're disciplined, investing in S&P 500, that could cover, or that could come after 25 years at 1.588653. So that is roughly about $1.6 million. And we also have to consider the actual cost. So instead of buying a house, if we keep on renting, we also save $60,000 initially because we are not putting down payment, we are not having a closing cost or any sort of expense in the initial phase. So that ROI of that initial investment would come at $730,000. So the total comes at $2.3 million when you keep on renting and invest everything that you save of not buying a house. Now let's look at when you buy a house and how you build equity on it. Will it beat the rent or not? So here's the thing, like $700,000 is the purchase price. Most of the people buy a house to have an equity in that and they can trade off for something else in future. Now, if we see a ROI after 25 years, now 7%, I have considered 7% in this one and 5% for this because 7% is what we are getting from 2011 to 2024 based on Waterloo Region Board data. So based on 7%, our $700,000 house would roughly become $3.8 million after 25 years. Now, it might sound too much, but this is something a real data is. And for this one, I've also considered 5% because not many people would want to consider 7%. Even I would not consider 7% for this video. I would only consider a conservative 4 to 5%. So at 5%, we are getting a return of 2.3. So our house of $700,000 will, after 25 years, will fetch a value of $2.3 million. Now let's compare renting into buying on actual number over here on side by side basis. So if you see in renting, what we have considered is like ROI of 25 years that will be 1.5, almost $1.6 million if we keep on investing that money regularly on S&P 500 or whatever preference you have at 10% return. And ROI on initial investment is $730,000. That brings us to grand total of $2.3 million. And if we have to buy a house, the equity of a $700,000 house after 25 years would be roughly about 2.37. So that has a difference of roughly about $50,000. Now, many people might not consider this as a good financial sense to buy a house in this case because the $50,000 difference that you're getting after 25 years, that $50,000 value right now based on the inflation comes roughly at about 10 to $15,000 or lower than that. Not many people would want to go for all that hassles and stuff like that. But here's something that happens after 25 years and why majority of the people still consider buying a better option because this is what happens after 25 years. The very first thing happens is, let's say if you buy a house when you are 30s or 40s, after 25 years it's highly likely that you are at the age of retirement. But for majority of the people at the age of retirement, their income drastically decreases, and at that time you have a paid off house. Of course you have to pay property tax and maintenance on it, but not a rent. Unless if you are renting it out, you will be paying roughly about $4,800 every month out of pocket if you keep on renting. And in terms of house buying, that will be roughly about $1,000 to $2,000. So a double to triple times if you keep on renting. And another argument to this is like it's very unlikely you will keep on investing the same amount or the difference that you are getting from buying versus renting consistently for 25 years. Majority of the people will go into something called lifestyle inflation and they will have an extra cash to invest somewhere else. Or in case if you have emergency, you will tap into that cash and will not invest for that particular period of time. Another benefit of buying a house or why majority of the people consider buying a house is that like after 25 years when they are mortgage free or whatever the term look like, they can pass that house to their future generation. And here is also a counter argument to it. Like, unlike not many people would spend their time or full amortization of a 25-year in the same house. So, as soon as you move towards a different house, your interest portion goes higher and amortization table works that way. Like, for a initial amount of time or initial period of for few years, your interest portion will be higher and the principal portion would be very low. And in this case, you will create your own cycle again. And one more interesting stuff that I want to share is that homeowner have a 30 times more net worth than renters. This is something I found on Nesto and just want to share it over. So it's totally up to you at the end, like whether you want to buy or rent. And if you are someone who's disciplined, who are investing their money wisely, then definitely renting seems a better option for a few years. But at the end, buying definitely have a good pros compared to renting. And it also depends on where you live because that will also have a major impact between renting versus buying an option. In cities like Toronto, renting might be a good option if you are not planning to stay there for a longer period of time. And I would highly recommend if you're in a process of buying or considering buying, sit down with your family, do an actual budgeting, and calculate what are your numbers come and stick to it. Thank you so much for watching. If you found this video helpful, please do me a favor, like and subscribe to my channel, and I will see you next time.